We're going to look at 3 examples of how to record bad and doubtful debts, just to account for the 3 possible scenarios that we might expect on the exam. So the first one is, let's just take the most common example, and we'll call that example 1. But it doesn't matter what example we get. All we're ever going to do when we're doing bad and doubtful debts is follow a 3-step process called the income statement approach. And what we do is step 1, we fill up the tank for this period. We recognize that a certain percentage of our accounts receivable just will not repay. So what we do is we make something called an allowance for doubtful debts, which is a negative asset, and we fill it up. So we might estimate that $4,000 of our current accounts receivable won't repay. We don't know who, it's just an estimate because logically some just won't repay. Step 2, we use the tank when needed. We wait until a specific account receivable, we know their name, is declared a bad debt. They're bankrupt or in liquidation or they've gone missing and we can't find them. And what we do is we take out the amount that we've used. So we have a $4,000 allowance and we take out, if we find out an account receivable that owes us $1,000 plus GST is bankrupt, we take out what we need and now it's used. So that leaves $3,000 in the tank. Step 1, fill up the tank. Step 2, use the tank when we need it. Step 3, at the end of the current period, refill the tank up for next period. So at the end of this period, we'll have a certain number of bad accounts receivable, and we might estimate a certain percentage of those won't repay us, and we figure out that comes to $5,000. And at the moment, we've only got $3,000 in our tank, so we need to top it up with another $2,000. And that's our 3-step process. Fill the tank up for this period, step 1. Use the tank when needed, step 2. Refill the tank up for next period, step 3. So let's now deal with the debits and credits of that. And let's just sort of look at conceptually what this allowance for doubtful debts is. It just assumes that some of the people we sold to on credit this period, called accounts receivable, may never pay the business. But we don't know which ones. It's just logical that if we go and look at past history, a certain percentage of accounts receivable won't repay. And what we've got to do is record an expense for that this period so we can match revenues earned for this period with expenses incurred. So let's say we had a trial balance with accounts receivable of $54,000. Well, what we should do is recognize that it's very unlikely that all $54,000 will repay. So what we should do is record an allowance for doubtful debts, which is a negative asset. So if assets have debit balances, an allowance for doubtful debts, which is a negative asset, will have a credit balance. But how much should it be? We've got to give this negative asset an amount. And that will be given to us in the question. But what we can do is we can think of it as a big tank of accounts receivable who may not repay. And we don't worry about GST for step 1. And we'll just deal with that and we'll explain why in a second. So let's take step 1. We need to figure out how much to put in this tank for the allowance for doubtful debts. And we've been told sales were $105,000 and all sales are made on credit and sales returns were $5,000. An analysis of past sales data indicates that 4% of net credit sales should be classified as doubtful in terms of whether they will ever be repaid. So let's take our allowance for doubtful debts. To get that, we take our net credit sales and we multiply it by the percentage allowance. So the net credit sales is the amount of your credit sales minus sales returns. So credit sales, it says here, sales were $105,000, but we don't know whether they're cash or credit, but this additional information says all sales are on credit. So this number here is 105. Sales returns is 5. So 105 less 5 is 100,000. Times by the allowance, which is 4%, we need to plan for and allow for $4,000 of accounts receivable not repaying us. We're going to fill that up and put it in the allowance for doubtful debts tank. What does that look like in terms of debits and credits? So let's just summarize and say fill up the tank for this period. On the 30th of June, make an allowance for doubtful debts of 4% of $100,000 of net credit sales. And what we do is we record a bad debt expense. So we always, when we're doing these balance day adjustments, the first thing we always do is debit the expense. We're going to make an expense called bad debts of 4,000, and that is simply the estimate of the people who aren't going to pay us out of our accounts receivable, and we're going to record that as an expense today. Even though it hasn't happened, we're just planning because past analysis says roughly $4,000 is about right. And every debit needs a credit. So the credit is going to be to the allowance for doubtful debts, and that's a negative asset. So when it goes up, that's a credit. So that fills the tank up to $4,000. Step 2, and we might get asked for a narration, and we just say something like, allowance recorded for doubtful debts of 4% of net sales, and we'd put the memo number in. Step 2, use the tank when needed. So we can see the tank has $4,000 of expected accounts receivable who will never pay. And on the 6th of July, so this is in the next period, because previously this was at the 30th of June, and a specific account receivable who has a name, in this case Jerry Seinfeld, has been declared bankrupt, and their account of $1,100, which represents a $1,000 sale plus GST, is a bad debt. So what we need to do is we need to plan for, well, we thought $4,000 of accounts receivable would not repay us, and so far $1,000 of that hasn't. So we need to use that. So what we're going to do is we're going to use up $4,000 of this, $1,000 of this tank. So what we can see here is allowance for accounts receivable was a credit, and that increased the tank. Well, now we need to decrease the tank. So if it was a credit to increase the tank, it's a debit to decrease it. So we would debit the allowance for doubtful debts by 1,000. And effectively what that's saying is I've now used $1,000 of my allowance, and I've got $3,000 unused. So that is there in case any other accounts receivable end up going bankrupt and won't repay. What I also need to do is do a debit to GST clearing. So that reduces my liability, and that makes sense. If this person is never going to repay us, I should not have to give the GST to the government, so I can decrease my GST clearing liability. And lastly, the balance of accounts receivable, well, I'm not going to get the $1,000 for the sale plus the $100 for GST, so that would decrease accounts receivable. And accounts receivable is an asset, and when it goes down on the credit side, and we can see our two debits for 1,000 and 100 match our credit of 1,100. Possible narration, we just say amount owing from Jerry Seinfeld written off as irrecoverable, memo 2. So we filled the tank up, step 1, with 4,000. We used up 1,000, so now there's 3,000 left. And then at the end of the month, let's say we didn't use any more of it. No one else went bankrupt. But what we do is on the 31st of July, we're going to make an allowance for doubtful debts of 4% of net credit sales this period. And let's say net credit sales this period was 125,000. And we're going to do the exact same debits and credits we did here, but just apply them to the current number. So what is 4% of 125,000? So if we take 125,000 and times it by 4%, that is 5,000. So what we're saying, out of the current accounts receivable, I expect $5,000 won't repay. I don't know who, so I'm just going to make an allowance for doubtful debts. But the problem is my tank only has $3,000 in it, so I need to get it to 5,000. So what I'm going to do is copy my exact same debits and credits here, but I'm just going to get it from 3,000 to 5,000. So I will do a debit the expense of bad debts 2,000 and a credit to the allowance for doubtful debts of 2,000. And now we can see I've still got 3,000 unused from the last time. I've added another 2,000. So together, my allowance for doubtful debts is now 5,000, and that's what it should be. It should be 4% of 125,000. And if we were asked for a narration, we'd make the exact same narration now. Allowance recorded for doubtful debts of 4% of net sales, memo 3. And that is the entire process. So if you understand that now, you can probably skip to the next video. What I'm going to do for the rest of this video is just break down each of these steps one by one in a little bit more detail in case you're having trouble understanding what each step actually is. But if you understand that sort of process, fill up the tank this period. Step 1. Step 2, use the tank when needed. Step 3, refill the tank up for next period. That's it. But if you did want to sort of go into the detail a little bit more, let's look at step 1. So we said the allowance here needed to be 4,000. So this was at the end of June. So what we did was we touched 3 accounts. We've got accounts receivable at the moment has a debit balance of 54,000. And what we did on balance day was we increased our allowance by debiting the expense. So I went to bad debts expense and did a debit of $4,000 there, and we say that is debiting the expense. And the credit was a credit to the allowance for doubtful debts, and that's a negative asset, so it goes up on the credit side, and that had the effect of filling up, so that goes there, of filling up the tank. I expect out of my accounts receivable of $54,000, $4,000 of them to never repay. Just doing my narrations here. So bad debts would reference allow for doubtful debts, and the allowance for doubtful debts account would reference bad debts. And that's step one with our narration there. Step two, in our balance sheet, we need to make an adjustment. So let's just look at that. What we should do now is we should update accounts receivable in the balance sheet with the allowance for doubtful debts. So under current assets, we should have accounts receivable. It's got a balance of 54. But what we do now is we say, well, actually, let's less the allowance for doubtful debts. I don't think all 54,000 are going to pay. So what I've got here is this allowance of 4,000, and I put that there. And essentially what I'm saying is, really the net or overall balance of accounts receivable that I could expect to collect is 50,000, which was 54 less 4 for a total of 50. Step two, use the tank when we need it. So when an account receivable actually becomes a bad debt, use up the allowance for doubtful debts tank, and now we do need to factor in the GST that the customer owed. So we've got the unused tank of $4,000 of doubtful debts, and we're saying let's use it up when someone actually becomes a bad debt. So let's say on the 6th of July, we received notification that Jerry Seinfeld has been declared bankrupt, and their account of $1,100, which was a $1,000 sale plus GST, is now irrecoverable, memo 2. So we've got the ledger account receivable, which has 54 in it. We've got an allowance for doubtful debts with $4,000, which matches our tank here. And we've got a GST clearing ledger. So what we're going to do is use up our allowance for doubtful debts. We're going to use up 1,000 of it because the customer owed $1,100 and $1,000 of that was the sale. And that's this part here. So if it was to increase allowance for doubtful debts was a credit, to decrease it is a debit here. So that makes it go down. So we could say a negative asset would go down on the debit side. And what that does is it uses up, we just go back, that uses up $1,000 of this tank because I planned for it. I planned that $4,000 of sales would not repay. And now, right now, $1,000 of that isn't going to repay. What would our credit be? Actually, we've got another debit before that. I don't have to give the government, so the GST is a liability, but I don't have to give them the $100 that this customer owed. So I can decrease my liability with a debit of $100 there. And lastly, accounts receivable are not going to repay me. Specifically, Jerry Seinfeld is not going to repay me $1,000 for the sale and $100 for GST. So it should go down $1,100 on the credit side here. So let's get our referencing. So allowance for doubtful debts and GST will reference accounts receivable, and accounts receivable will reference allowance for doubtful debts / GST clearing. Put our narration in if we're asked. Step 3, fill the tank back up. So refill the allowance for doubtful debts tank with a bad debts expense, no GST, in the next period. So let's say at the end of the next period, which is July, accounts receivable has $75,000 in it. We don't expect all of them to pay. But the problem is our allowance for doubtful debts only has $3,000 left. So we originally put 4 in, but we used 1,000. So at the moment there's 3,000 left. During the period, our sales were 135 and our sales returns were 10,000. So additional information says all sales are made on credit. So all these sales here are credit sales. An analysis of past sales again says that 4% of net credit sales should be classified as doubtful in terms of whether they will ever be paid. So what should the allowance for doubtful debts be? Well, it's going to be our net credit sales again, times by the allowance. So in this case, credit sales was all of this number here. Sales returns were 10. So 135 less 10 is 125. Times that by the allowance, which is 4%. And 125,000 times 4% is 5,000. So we need to allow, out of this account receivable here of 75,000, we don't think $5,000 of that will be collected. We don't know who though. So what we do is we make an allowance for doubtful debts. But we don't need to make an allowance for all of the 5,000 because we've still got $3,000 unused from last period. So what I'm going to do is kind of top up the difference. So, and we're going to do it with the exact same debits and credits as last time. I'm going to get this allowance for doubtful debts from 3, which is where it's at now, to 5. So, how did I do that? Well, we always with our balance day adjustments. So we've got our accounts receivable there with a balance of 75. We've got our allowance for doubtful debts, which now has a balance of 3. Bad debts was cleared out because that was an expense. It would have been closed last period. And the first thing we're going to do is, just like we did in step 1, debit the expense for 2,000 here. So an expense goes up, that's a debit. We always debit the expense. Why 2,000? Because we've got to get the allowance from 3 up to 5. So we debit another 2,000. The credit goes here to allowance for doubtful debts, just like it did in step 1. And that's it. We do our referencing. So we can see here that topped it up now by 2,000. So we've got 3,000 left over. We topped it up another 2,000. Together that equals 5, which is what we said our allowance should be. So we do our referencing here. Allowance for doubtful debts. Bad debts there. And our allowance now, instead of saying 3,000, will actually say 5,000, which is exactly what we want. We think 5% of, $5,000 of this accounts receivable won't be recovered. So we just would update the balance sheet now, and we'll just say accounts receivable was $75,000 balance, but we don't think we'll get all that. So we had originally, let's take the allowance for doubtful debts ledger from the whole time we did this. The first thing we did on the 30th of June, step 1, was we put 4,000 in there. Step 2, we used up $1,000 of it when accounts receivable Jerry Seinfeld went broke. And then we said the balance it was 4 minus 1, so that was 3,000. So we just topped it up at the end of July with another 2,000. And if we balance that, we'd add up the bigger side here, 6,000. Write the same number on this line here. Take away the 1,000, that gives us a balance at the end of July of 5,000. Carry that forward into the next period. But what we should do in the balance sheet at the end of July is say accounts receivable is 75,000, but we're not going to collect that. What we should do is less the allowance for doubtful debts of 5,000, which is the balance here. So I really only think I'm going to collect $70,000 of that in the future.